This program was first broadcast on Canterbury's access media station, Plains FM, and was made with the assistance of New Zealand On Air.
Welcome to your weekly dose of the Accountology Show. I'm your host and chartered accountant, Nicole Haig, with an insatiable curiosity for uncovering accounting ideas to help businesses grow. I have so many nuggets of gold to share. Are you ready to make your good business great? Let's get stuck right in. Hey, it's your host, Nicole Haig, and welcome to another episode of the Accountology Show. Right, flashing accounting news. GST on Uber and Airbnb. If you've been booking trips on Uber or Airbnb since the 1st of April, you may have noticed that prices have increased. So there's new legislative requirements by the New Zealand government that GST be applied to the platforms of Uber and Airbnb, for example, from the 1st of April 2024, which is the result of a so-called app tax. So this new app tax requires these platforms to collect 15% GST, even if the Uber driver or the host of the Airbnb is not registered for GST if they make less than $60,000 a year, which is the GST threshold to be registered. However, those drivers or hosts not registered for GST will receive an 8.5% credit back from the platform to cover the GST that would have been claimable on the Uber or property's expenses. Confusing, right? Well, the aim of this app tax is to provide an even playing field for the gig economy services and traditional accommodation and transport providers. But as there were changes to the legislation right up to the end of March, there's still a lot of confusion and uncertainty about this GST. So if you're an Uber driver or an Airbnb host, contact your accountant to find out about your GST requirements, especially if you own accommodation, because if you're forced to register for GST and are using the property predominantly for making taxable supplies, you could get caught in the GST net if you sold the property. So if you are, however, under the threshold, you should not have to pay GST when you eventually sell the property. But remember, check with your accountant for specifics, as this is not specific tax advice and of a general nature without understanding your intentions or certain circumstances. Are you a business owner struggling with profit, cash flow, or to find balance between work and life? At Nicole Haig & Associates, we want to help business owners just like you reclaim your freedom. Freedom to spend quality time with loved ones, freedom from stress, and freedom from financial burdens. But how do we do it? It's simple. We listen, we understand, and we create bespoke, structured programs tailored to your unique business and personal goals. With the right education, coaching, and expert advice, we'll show you how to increase profits, improve cash flow, and align your business and personal goals. Don't do it alone. Let NH plus A be your guide to success. Work smarter, not harder, with our proven accountability methods. Your freedom starts here. Contact us today. Okay, so in today's show, we're going to talk about the somewhat boring yet all-important topic for business owners, income tax. Specifically, provisional tax versus terminal tax. I know, contain your excitement, but I promise I won't put you to sleep. The provisional tax system can be really difficult to navigate, and a simple tax plan will give you a general idea of how much tax will be payable and when, so you can plan your cash flow for it. So for most of you, your next provisional tax payment will be for the year ended 31st of March 2024, is actually on the 7th of May 2024. So listen up so you can make sure that you will be paying the correct amount. We're going to cover what is provisional tax and terminal tax, how does provisional tax work, the different provisional tax methods, the timeline. What if you're a startup business? Do you have to pay tax in your first year of business? Can't make your provisional tax payments on time? We've got some suggestions for you. And interest and penalties for late payments. Okay, so what you need to know. Firstly, what is provisional tax? So provisional tax is income tax paid in advance. So we're effectively crystal ball gazing, estimating how much your profit will be at the end of the financial year, calculate tax on that, and then split it in 3 payments, because there's 3 installments generally for most taxpayers. Terminal tax. So this is also a form of income tax, but it's the square up at year end. So once your accountant completes your tax return and calculates exactly how much tax you should pay based upon your actual performance, less your provisional tax paid, which is, like I said, your tax in advance, this will leave either a terminal tax credit or a refund. So that's if you've overpaid your provisional tax, or a terminal tax bill to pay if you haven't paid enough. You don't want to end up with a large tax bill at year end, right? So that's gonna hurt, especially if your accountant advises you out of the blue. So it's important to get your provisional tax right so your terminal tax is negligible and to avoid potential interest and penalties imposed by IRD. We'll talk about that more later in the show. If you're an employee, your employer sorts out your PAYE on your behalf, so you don't have to worry about it. But when you're self-employed or own a business, you need to pay your own income tax. For example, if you earned $100,000 in your personal name from your business as a shareholder's salary, the income tax on that income would be just under $24,000. That's a lot to pay all at once. So provisional tax breaks your income tax lump sum into installments that are paid throughout the year in advance, smoothing out your tax burden at year end. So how does provisional tax work? Provisional tax splits up your income into payments over the year, and generally speaking, the frequency is 3 times per financial year. However, the frequency of payments can vary from as little as twice a year to as often as monthly, depending upon the chosen of method to calculate the provisional tax that you've chosen. There are 4 methods that you can choose to calculate your provisional tax. There's the standard option, the estimation option, GST ratio option, and the accounting income method, which is AIM. So the standard option for provisional tax is calculated on the previous year's income plus 5%. That number divided by how many times each year you opt to pay is what you'll owe for each installment. So that's potentially 3 times a year. A lot of accountants use this option. However, be very wary of this option because not every business performance for the year is the same as the year before. So if you had an amazing year last year, then this year's provisional tax, if you use the standard method, would be last year's amazing performance plus 5%. But if your year is not performing near as well, this would mean that you'd end up paying too much tax, and that could really hurt your cash flow, making large tax payments, which in reality aren't required. You'll end up getting the overpayment of tax back, but only once your accountant's actually completed your income tax return. And that could be a number of months away before you actually receive the cash back. Equally, if the reverse was true, so last year's performance was dismal, but this year is booming, you will not have paid enough tax and you will end up with a big tax bill at year end. The estimation option. So on that basis, if you think that your income is going to be substantially more or less than last year, then suggest to your accountant that they estimate a more accurate figure and calculate your payments. So this is the method that we use with the majority of our clients. Like I said, it helps with cash flow and stops any nasty large bills arriving by surprise at year end. The GST ratio option and AIM method, you can ask your accountant about that for more details, or there is some more details on the IRD website if you wanted to find out. In terms of the timeline, this can get really confusing because generally provisional tax dates for the standard or estimated option are the 28th of August, 15th of January, and the 7th of May. Now this can get really confusing because if your financial year is 31st of March 2025, you would pay each of the 3 installments on, the first one would be the 28th of August 2024, the second one the 15th of January 2025, and the third one is on the 7th of May 2025. But that's after the end of the financial year, 31st of March 2025. Then if you have terminal tax to pay, that is due 7th of April the year following the end of the financial year. So in this example, if you had terminal tax to pay for the 31st of March 2024, this would be due on the 7th of April 2025. So all of a sudden you've got, in 2025, you've got January payments, May payments, April payments. It gets really messy. We actually have a timeline drawn out that you can download from our website, as it's often easier to see the timeline visually than to run this over in your head. So head over to our website for more. I'll put it in the show links. When does provisional tax kick in? Okay, so if your last total income tax for the year was below $5,000 and income below about $34,000, you don't need to pay provisional tax, but you will still owe income tax. You just don't need to pay it in advance. Once you earn enough to put you over that $5,000 threshold, you start paying provisional tax. It can be tricky in the years when you move up and down that provisional tax threshold, but you still owe the tax from the previous year, lower earning year. You might end up by paying both provisional tax for the current year and end of year from a previous year. So talk to your accountant about how you can manage the situation where you've got a lot of tax to pay for different years at the same time. Just be aware, just because you don't pay provisional tax, this only means that you don't need to make the 3 installments in advance during the financial year. You still need to pay tax, but it will be terminal tax paid in one lump sum at year end. So make sure that you put money aside in a separate bank account, so when your accountant asks you to make the payment, you've got the cash there. So what if you're new to business? You're a startup in your first year of business. So as a business owner, it's important you understand the provisional tax system as it does affect your business. We hear all the time new business owners saying, but you don't have to pay tax in your first year of business. Well, I hate to break your bubble. Whilst you're partially correct, you still have to pay tax. All you're doing is deferring it. And this can be a nasty trick for new players. So let me explain. In your first year of business, you can receive a significant tax deferral. Your first year's tax bill, in some cases, is not payable to the 7th of April the following year. So, for example, if you went into business in June 23, assuming that you've got a March balance date, your first year's tax bill would not be due and payable until the 7th of April 25, which is quite some time away. So your provisional tax for the following year may not be payable until May 25. The first 2 tax bills you sometimes receive in business, terminal tax for the previous year and the provisional tax for the current year, can be tough for a new business. So that would be paid on the 7th of April 2025. And then tax again in a month later in May. So that's nasty in terms of cash flow. If you aren't aware of these tax bills, that can be an awful shock and have a serious effect on your cash flow. So that is why we believe it's vital 6 months into your new business that you contact your accountant if you haven't already made contact, prepare a simple plan and have a general idea of how much tax will be payable and when. Then program the likely payments into your cash flow plans. And this is far better than waiting until the year end to find out about your tax commitments, get a double whammy, and end up with a serious cash flow crisis. But what happens if you cannot make your provisional tax payments? We suggest you let your accountant know if this is an issue for you, and then they can engage with Inland Revenue on your behalf. Inland Revenue can come up with an instalment arrangement with you so you can pay the tax off. But another strategy before you get to that stage of making the arrangement with IRD is tax pooling. So this is essentially buying tax. So a tax pooling intermediary is like a bank with deposits from other taxpayers of overpaid tax. And you can use these funds to purchase tax at the correct date you need. And this is important that the date is correct. Otherwise you'll end up with late payment penalties and use of money interest, but more on that later. And pay an interest rate that is less than what the IRD charge, and pay for that tax at a later date, helping out your cash flow. It's great for seasonal business and builders or developers who don't get paid until the building is completed. How tax pooling works is it allows you to have an extra 75 days past your terminal tax date to pay provisional tax or terminal tax payments for the current year or the one just completed. So this can be really helpful. Get your accountant onto it if that is an option for you. The provisional tax system is complex, and if you want to know more, the IRD have a guide on their website which you can download, the Guide to Provisional Tax for Business Owners. Okay, use of money interest. So some taxpayers are subject to use of money interest when they don't pay their tax or pay it late or they underpay it. Underpaid tax can lead to use of money interest being charged by IRD, and the use of money interest has increased, as you'd expect, in recent years, in line with interest in general increasing. The IRD have purposely made these interest rates higher than the bank rates to discourage you from using this as a funding mechanism. And people say, well, the interest rate at the IRD I'll be charged is not much, so I'll just pay my tax late. As at August 23, the interest rate on the use of money interest was 10.91%. So that's a good couple of percent higher than the current bank rates. And here's a tip. Make sure you have a broad idea of your likely tax commitments in advance so as to avoid use of money interest and late payment penalties. Okay, so how is the actual amount of use of money interest calculated? Like I said, use of money interest rates are set by IRD and they're set at a level intended to discourage taxpayers from using IRD like a bank. So if you're late paying your taxes, you will incur a use of money interest charge until the account is clear. Even if you enter into an installment regime with the IRD to pay off your taxes over time, you must pay the interest. In these cases, you'll often be able to avoid any further penalties like late payment penalties. Okay, and what if you have a seasonal business? The calculation formula for provisional tax does not take into account any seasonal variations that occur in your business income cycle. So for example, if you make most of your money in the latter part of the year, it makes no difference to the IRD in terms of the calculations. IRD will assume that your income was earned evenly throughout the year. So for cash flow purposes, you really need to have a plan in place to ensure that you have the funds set aside to make the provisional tax payments, even if cash flow is tight. Otherwise, you could consider strategies such as the tax pooling intermediary we talked about before. What are ways to minimise your use of money interest? Well, regular tax planning is important for your business. Where you're likely to fall into the interest regime, it may be advisable to make voluntary payments of provisional tax as you go, as it's likely that you'll find it cheaper to finance your tax payments through your trading bank or by using tax pooling intermediaries. We recommend that you obtain a good software accounting package like Xero, which produces reliable, regular management reports so you can see your income unfolding as the year progresses. You can run these reports yourself or you can ask your accountant to do that for you, as many of our clients do. Tax planning. Right. Well, tax may be boring, but smart use of tax planning is a brilliant way to help your business do more with your money. Tax planning is a strategic approach to managing your business's financial affairs with the aim of legally minimising your tax deductibility. So in other words, you plan ahead to make sure you pay the taxes you should be paying, but not a penny more. So working with your accountant, you can look for deductions, credits, exemptions, and tax saving strategies that will help to optimise your company's overall tax position. We touched on some of these legally deductible expenses in our first episode. And how does tax planning affect your business? The primary goal of tax planning is to reduce the amount of taxes your business owes, but it's also about making sure you stay compliant with all the tax laws and regulations applicable to your business. So what are the main advantages? So let's look at 5 of the big benefits of careful strategic tax planning. So by planning your tax across the year, you can minimize profits. So strategic tax planning helps your business find the best available tax incentives, deductions, and credits. And this reduces your overall liability, cuts your annual tax costs, and increases your overall profitability as a business. Boost your cash flow. Tax planning is a great way to open up more liquid cash and achieve a better cash flow position for the business. So when you cut down the company's tax payments, that frees up cash and helps you achieve a positive cash flow. The third way is to stay compliant and mitigate your risks. So by being proactive with your tax planning, keeps your business compliant with the relevant tax laws and regulations. And it's a sensible way to tick the compliance box and reduce the risk of costly penalties and legal issues. Drive your strategic growth. Smart use of the tax planning helps you reduce your tax costs and reassign these funds to your strategic business goals. It's a golden opportunity to invest in areas that promote long-term growth and competitiveness. And the last one, give your business a competitive edge. If managed well, efficient tax planning leads to lower operational costs for the business, and this gives you a competitive edge when it comes to pricing, innovation, sales, and revenue generation. Getting strategic with your tax planning has many advantages, as we've just gone over, for your financial stability as a business. But to maximise your planning, it's important to work with an experienced accountant. Your accountant should help you look ahead across the whole financial year, looking for opportunities to reduce your tax liability and find the best tax deductions and incentives. I hope that's made it a lot clearer as to what provisional tax is and what terminal tax is and the different methods that you can use to calculate the tax. If you keep receiving surprise tax bills from your accountant, then it's time to have the conversation about what methods of calculation should be used, or even time to look for a new accountant. Surprise tax bills are not necessary if you use the right options. Your accountant should be in regular contact with you around your provisional tax instalment time to determine what is going on in your business. So, 3 points of action for you to take away from this show today. Firstly, talk to your accountant about the best method to use to calculate your provisional tax so you avoid any use of money interest or late payment penalties, and help cash flow by not overpaying tax or underpaying and ending up with a large tax bill at year end. The second is let your accountant know as soon as possible if you cannot make your provisional tax payments. They can suggest other strategies such as tax pooling or entering into an instalment regime with the IRD. Don't bury your head in the sand. And the third action point, talk to your accountant about how they can help you in tax planning. It's a strategic approach to managing your business's affairs by legally minimising your tax liability. And aha moments, if there's one thing you can take away from this conversation, it should be calculation of your provisional tax is super important to get correct. Make sure you have a broad idea of your likely tax commitments in advance and prepare a tax plan to help you with your cash flow and what strategies you will use to finance your tax payments. If your income circumstances change, let your accountant know, as there may be provisional tax and interest consequences. And as always, remember to check with your accountant for specifics, as this is not specific tax advice and of a general nature without understanding your intentions or certain circumstances. Thanks for joining us on the Accountology Show. If you have enjoyed today's show, you're in luck because we'll be back next week. You'll find past episodes at plainsfm.org.nz and subscribe on Apple Podcasts or Spotify to never miss an episode. We would love it if you would leave a 5-star review and tell a friend or business owner who would benefit from hearing our show. We also love hearing from you, so reach out with any comments or a topic you'd like covered, and even suggestions for whom we should get in the studio next for an interview. You can find us on Facebook, Instagram, LinkedIn and TikTok. Our handle is NH Plus Associates, that's NHPLUS Associates, or email me, nicole@nh-a.co.nz. But most importantly, thank you for taking the time to listen to the show. Until next time, keep building that business into the empire it absolutely deserves to be.